Disclaimer. Right now, while most investors are staring at the price of Bitcoin and asking whether this is the beginning of another collapse, something much bigger is happening underneath the surface, and almost nobody is talking about it correctly. Because this isn't just about whether Bitcoin is up or down this week. This is about whether the structure that drives Bitcoin's entire cycle is quietly resetting for the next major move. And if you misunderstand this moment, you won't just miss a trade, you'll misread the entire cycle. Bitcoin is currently trading in a fragile zone. Volatility has compressed compared to the explosive moves we saw at prior peaks. Yet beneath that calm surface, liquidity dynamics, institutional positioning, macroeconomic policy, and long-term holder behavior are shifting in ways that historically precede major directional moves. And here's what most people get wrong. They think price leads structure. In reality, structure leads price. Let's zoom out. Bitcoin's total supply cap remains 21 million coins. Over 95% of that supply has already been mined. After the April 2024 halving, new issuance dropped to roughly 450 BTC per day, about 164,000 coins per year. Compare that to earlier cycles when annual issuance was significantly higher. The supply side has structurally tightened. That's not marketing, that's math. Now layer macro conditions on top of that. The Federal Reserve's benchmark rate remains restrictive relative to the ultra-loose monetary conditions that fueled prior crypto supercycles. Even after rate cuts from peak tightening levels, real rates remain positive. Liquidity isn't flooding the system the way it did in 2020, 2021. M2 money supply, after contracting for the first time in decades during 2022, 2023, has stabilized but has not re-entered aggressive expansion mode. That matters because Bitcoin has historically performed strongest during periods of expanding global liquidity. But here's the nuance most retail traders miss. Bitcoin no longer trades in isolation. It trades increasingly like a high beta macro asset, sensitive to interest rate expectations, equity risk appetite, credit spreads, and dollar strength. When yields rise sharply, Bitcoin feels pressure. When liquidity expectations improve, Bitcoin responds positively. It behaves less like an independent digital gold narrative and more like a leveraged expression of macro liquidity cycles. That evolution changes how we interpret current price behavior. If this were 2017, a 30 to 40% correction would simply be dismissed as volatility within a parabolic retail-driven mania. Today, corrections occur in a market integrated with institutional flows, ETFs, custody infrastructure, and macro asset allocation frameworks. That integration reduces some extremes but increases sensitivity to broader financial conditions. And right now, we're at an inflection point. ETF flows, particularly spot Bitcoin ETFs, have introduced a new variable. For the first time in history, large pools of capital can gain Bitcoin exposure without touching private keys or crypto exchanges. Pension funds, RIAs, asset managers, all can allocate through regulated channels. That's a structural shift. Access changes demand curves over time. But access cuts both ways. When institutions de-risk, ETF redemptions create mechanical selling pressure. When they allocate, inflows create structural demand. These flows are not emotional, they're systematic. And that means we must watch them closely because they often precede large directional price movements. Now let's talk about market psychology. Extreme greed and extreme fear tend to cluster near cycle turning points. When sentiment becomes universally bullish, upside momentum often exhausts. When sentiment collapses into despair, selling pressure eventually depletes itself. But sentiment alone doesn't drive cycles. Liquidity does. Bitcoin has historically followed a 4-year rhythm anchored around halving events. But halving alone doesn't create a bull market. It reduces supply growth. The demand side must still expand. In prior cycles, that demand expansion was fueled by retail mania and liquidity surges. In this cycle, the demand composition looks different. More institutional, more macro-driven, more correlated with global capital flows. So where does that leave us right now? We are in a transitional phase. Not full euphoria, not full capitulation. A compression zone where volatility tightens, narratives conflict, and market participants debate whether the cycle peak has already occurred or whether another expansion phase lies ahead. History offers perspective, but not certainty. In 2017, Bitcoin experienced multiple drawdowns exceeding 30% before reaching its final peak. In 2021, Bitcoin printed a double-top structure separated by a deep correction. In 2022, it endured a brutal deleveraging event as excess speculation was purged from the system. Each cycle felt terminal in the moment. Each eventually reset. But here's the difference today. The market is more mature. Derivatives markets are deeper. Institutional custody is widespread. Regulatory clarity, while still evolving, is greater than ever before. Bitcoin is no longer an experimental fringe asset. It's a macro-sensitive, institutionally integrated digital commodity. That doesn't eliminate volatility. It changes its character. Now ask yourself this question. Is the current price action signaling structural breakdown or structural reset? If supply growth has permanently slowed due to halving, if institutional access has permanently expanded via ETFs, if macro liquidity is stabilizing rather than contracting, then what exactly would invalidate the long-term thesis? Not short-term price weakness, not a 20% drop, not even a 40% correction. Structural failure would require collapsing demand, disappearing institutional participation, or permanent macro tightening that strangles liquidity for years. We are not currently seeing those signals, but we are seeing caution. And caution is different from collapse. One of the biggest mistakes retail investors make is confusing volatility with failure. Volatility is violent, emotional, dramatic. Failure is structural and sustained. Right now, what we're observing resembles volatility inside a macro transition, not systemic abandonment. But that does not mean upside is guaranteed. Bitcoin still faces real headwinds. Sticky inflation could delay rate cuts. Strong dollar environments can pressure risk assets. Equity market weakness can spill into crypto due to correlation effects. ETF inflows could stall. Liquidity expansion could remain muted. All of these variables matter. That's why blindly buying or panic selling misses the bigger picture. At Bullion Finance News, we focus on structure, not noise. If you want data-driven breakdowns that cut through emotional narratives and show you what's actually moving markets, make sure you're subscribed, because the next phase of this cycle will reward clarity, not hype. Now here's where things get interesting. On-chain data is beginning to reveal shifts in holder behavior. Long-term holders, wallets holding Bitcoin for over 155 days, are historically the strongest hands in the market. When they begin distributing aggressively, cycle tops often form. When they accumulate or hold steady during corrections, it often signals structural confidence. Meanwhile, exchange reserves have trended lower over the long term compared to prior cycles, indicating reduced immediately liquid supply. At the same time, derivatives open interest remains elevated relative to historical baselines, meaning leverage still plays a role in short-term volatility spikes. This combination, tighter supply growth, institutional access expansion, leverage sensitivity, and macro dependence, creates a compressed spring effect. Markets don't remain compressed forever. They resolve. The real question isn't will Bitcoin move? It's which force breaks first, liquidity expansion or macro tightening? In the next session, we're going deeper. We'll break down leverage positioning, liquidation mechanics, whale wallet behavior, realized price metrics, and what they are signaling about the probability of a major directional move. Because once you understand how leverage interacts with long-term supply dynamics, you stop reacting to candles and start anticipating inflection points. Because Bitcoin doesn't just move when people buy or sell. It moves when positioning becomes imbalanced. And right now, positioning is telling a much more important story than headlines. Let's start with leverage. Bitcoin's derivatives market is now larger and more influential than spot volume on many days. Futures open interest across major exchanges remains elevated compared to pre-2020 levels. That means more traders are using borrowed exposure, both long and short, to amplify moves. Leverage acts like dry wood in a forest. Price is the spark. When too many traders crowd one side of the trade, liquidation cascades can trigger violent moves in the opposite direction. We've seen this repeatedly over the past few years. Sudden 8%, 10%, 15% intraday moves, not because of news, but because of forced liquidations. Funding rates are one of the clearest short-term positioning indicators. When funding turns excessively positive, it signals crowded longs paying to hold positions. When it flips sharply negative, shorts are dominant. Neither extreme tends to last. Extremes create opportunity, but only when aligned with macro structure. Right now, funding has normalized compared to euphoric peaks, but leverage has not disappeared. That means the market is coiled, not cleansed. Now, let's connect this to liquidity mechanics. Bitcoin trades 24/7 globally, but liquidity is not evenly distributed. US trading hours, ETF inflow windows, and macro data releases create volatility clusters. When US equities open strong and risk appetite improves, Bitcoin often follows. When yields spike or dollar strength accelerates, Bitcoin can react within minutes. The US dollar index remains one of the most underappreciated drivers of Bitcoin price action. A strengthening dollar tightens global liquidity conditions. A weakening dollar typically coincides with risk-on behavior. Bitcoin historically performs best when the dollar softens and real yields decline. Now ask yourself, are we currently in a regime of expanding global liquidity? Not aggressively. But we are no longer in aggressive contraction either. That's the difference. Liquidity contraction destroys speculative excess. Liquidity stabilization allows rebuilding. Liquidity expansion ignites euphoria. We appear to be in the stabilization phase, which historically precedes expansion, but does not guarantee timing. Now, let's talk about long-term holder behavior, because this is where conviction lives. Long-term holders control a significant percentage of circulating Bitcoin supply. Historically, during deep bear markets, these holders accumulate heavily. During late-stage bull markets, they gradually distribute into strength. Recent on-chain metrics suggest long-term holder supply remains elevated. Distribution has occurred during rallies, but not at panic levels. That suggests strategic profit-taking rather than structural exit. Short-term holders, on the other hand, are far more reactive. When price dips below their cost basis, fear increases. When price rallies above it, FOMO returns. Monitoring realized price bands, which estimate the average cost basis of different holder groups, gives insight into who is under stress. Currently, Bitcoin trading near or above the short-term holder, realized price tends to support continuation. Sustained breakdown below it increases risk of cascading selling. This level acts like a psychological and structural pivot. Now let's bring whales into the conversation. Large wallet addresses, particularly those holding over 1,000 BTC, often accumulate quietly during periods of fear and distribute into retail excitement. Recent data shows mixed behavior, some profit-taking near highs, but not broad-scale exodus. That's important. Massive whale dumping typically precedes prolonged bear markets. We are not seeing that pattern at scale right now, but here's the critical point. Markets top not when everyone sells, but when new demand fails to absorb supply. That's why ETF flows matter so much. If inflows remain steady or resume acceleration during dips, structural demand is absorbing distribution. If inflows stall for an extended period while supply increases, pressure builds. Watching weekly net inflows gives clearer signals than watching hourly candles. Now zoom out again to cycle theory. Bitcoin's prior cycles showed exponential expansion after halving events, but each cycle's percentage gains diminished relative to the previous one. That's natural for a maturing asset with larger market capitalization. Going from $1 billion to $100 billion is easier than going from $1 trillion to $5 trillion. Diminishing returns does not mean diminishing relevance. It means volatility compresses as capital base grows. The current market cap implies that for Bitcoin to double, hundreds of billions in additional capital must enter. That's why macro liquidity alignment matters more than ever. Retail mania alone is insufficient at this scale. Now consider equity markets. Bitcoin's correlation with major U.S. indices has fluctuated, but remains meaningful during risk-off events. If equities enter a sustained correction due to earnings compression, credit tightening, or macro shock, Bitcoin may not remain immune, even with strong fundamentals. However, when equities stabilize and liquidity expectations improve, Bitcoin tends to outperform as a high beta expression of optimism. So here's the framework you need to internalize. Short-term moves are leverage-driven. Mid-term moves are liquidity-driven. Long-term moves are supply-demand structural shifts. Right now, leverage is elevated but not euphoric. Liquidity is stabilizing but not expanding aggressively. Supply growth has permanently slowed due to halving. Institutional access is broader than any prior cycle. That combination creates asymmetry, but patience is required. Many investors are waiting for certainty. Markets do not reward certainty. They reward positioning before consensus becomes obvious. But positioning blindly is not strategy. In the next session, we're going to examine macro catalysts that could trigger the next major move. Federal Reserve policy trajectory, bond market signals, inflation expectations, credit spreads, and how each scenario impacts Bitcoin's probability distribution over the next 6 to 12 months, because the next cycle move will not begin with a tweet. It will begin with a shift in liquidity conditions that most people won't notice until price has already moved 20%. If you really want to understand where Bitcoin goes next, stop staring at the chart for a moment and look at the bond market. Because the bond market is where the real signal lives. Bitcoin is no longer just a retail speculation cycle. It is now deeply connected to U.S. monetary policy, treasury yields, and global liquidity flows. And the next major move, whether expansion or compression, will be triggered by macro shifts, not crypto Twitter sentiment. Start with the Federal Reserve. The Fed's policy rate sits well above the emergency levels of 2020. Even with gradual easing expectations, real rates remain restrictive relative to the ultra-accommodative environment that fueled the 2020-2021 liquidity boom. Inflation has cooled from peak levels, but it has not fully collapsed back to the Fed's long-term 2% target in a straight line. That keeps policymakers cautious. Well, why does this matter for Bitcoin? Because Bitcoin thrives when liquidity expands faster than risk perception. When financial conditions loosen, lower yields, weaker dollar, improving credit availability, capital rotates into higher beta assets. When financial conditions tighten, rising yields, strong dollar, widening credit spreads, speculative appetite contracts. Now look at treasury yields. If long-duration yields trend downward due to slowing growth or controlled inflation, liquidity expectations improve. Lower yields reduce opportunity cost for non-yielding assets like Bitcoin. That environment historically aligns with upside expansion phases. If yields spike due to persistent inflation or fiscal instability, liquidity tightens. Higher real yields increase the attractiveness of fixed income relative to risk assets. That environment compresses speculative demand. Right now, yields have cooled from peak panic levels but remain structurally elevated compared to the prior zero-rate era. That places Bitcoin in a balancing act, not suppressed by aggressive tightening, but not fueled by explosive easing either. Now let's talk about the US dollar. A strong dollar drains liquidity from global markets. A weakening dollar injects breathing room. Bitcoin has historically shown inverse tendencies to dollar strength during major macro phases. If the dollar enters a sustained weakening cycle, Bitcoin could benefit disproportionately. But the dollar weakens sustainably only when either US growth slows relative to global peers or when rate differentials compress. That brings us to recession risk. If economic data softens meaningfully, markets will price in faster rate cuts. That could initially create volatility across risk assets, including Bitcoin. But historically, once rate cut cycles begin and liquidity expectations reset, risk assets find support. However, if inflation reaccelerates unexpectedly, forcing the Fed to maintain restrictive policy longer than markets anticipate, liquidity conditions could tighten again. That would delay Bitcoin's next expansion phase. This is why we must think in probabilities, not certainties. Scenario 1, controlled disinflation, gradual rate cuts, soft landing. Liquidity stabilizes and slowly expands. Bitcoin grinds upward with volatility, potentially retesting or exceeding prior highs over time. Scenario 2, hard landing recession. Initial risk-off shock hits all assets. Bitcoin corrects sharply in the short term. But aggressive monetary easing follows. Liquidity expansion ignites a powerful recovery phase. Scenario 3, inflation resurgence. Yields rise again, dollar strengthens, risk assets compress. Bitcoin enters prolonged consolidation or deeper correction before any structural expansion. Which scenario is most likely? Right now, markets appear to be pricing something closer to controlled disinflation with gradual easing. Not panic recession, not inflation reacceleration. That middle path creates sideways volatility before decisive breakout. But here's the deeper layer. Bitcoin's halving has already reduced structural supply growth. Unlike prior cycles, the demand side now includes institutional capital via regulated investment vehicles. That means when liquidity does expand meaningfully, the transmission mechanism could be faster and more powerful than retail-driven cycles of the past. Now consider global liquidity beyond the United States. Central banks globally have begun shifting away from synchronized tightening. Some are easing, others are pausing. China's liquidity conditions, European growth stability, and emerging market capital flows all indirectly influence Bitcoin's macro environment. Bitcoin is global, but US liquidity remains the dominant driver. Credit spreads are another underappreciated signal. When corporate bond spreads widen aggressively, it signals rising financial stress. That environment typically pressures speculative assets. When spreads tighten, risk appetite returns. Monitoring credit markets often gives earlier warning signals than crypto charts. Now here's where patience becomes critical. Markets front-run policy changes. Bitcoin may begin moving months before official rate cuts or macro headlines confirm the shift. That's why waiting for confirmation often means entering late. But jumping in blindly without macro alignment increases risk. Right now, the data suggests we are in a macro transition zone. Tightening phase largely behind us, expansion phase not fully ignited, liquidity rebuilding slowly beneath the surface. That type of environment produces choppy price action, shakeouts, false breakouts, and sentiment whiplash. And that's intentional. Markets move in ways that maximize emotional pain for the majority. If too many expect immediate upside, volatility increases. If too many expect collapse, short squeezes ignite. The next major move will likely begin when positioning is exhausted and macro alignment shifts decisively. So what are we watching over the next 6 to 12 months? Sustained decline in real yields, consistent ETF net inflows absorbing supply, stabilization or weakening in the US dollar, no aggressive reacceleration in inflation, credit spreads remaining contained. If those align simultaneously, the probability of structural upside expansion increases significantly. If they diverge, particularly if yields spike or inflation surprises upward, expect volatility compression or downside pressure. This is not about hype. This is about probability stacking. Bitcoin does not need perfect macro conditions to rise. It needs improving conditions relative to expectations, and expectations right now remain cautious. In the final session, we're going to build the forward roadmap, mapping potential price pathways, cycle timing expectations, diminishing return dynamics, psychological traps, and what the next true cycle breakout would actually look like structurally, not emotionally. Because understanding the roadmap is how you avoid being shaken out before the move that defines the cycle. Now let's build the roadmap. Not hype, not moon targets, not fear narratives. A structural probability map based on how Bitcoin has historically behaved, adjusted for how the market has evolved. First, understand this clearly. Bitcoin cycles are expanding in time and compressing in percentage returns. In 2013, gains were exponential and violent because market cap was small. In 2017, returns were still explosive but less extreme. In 2021, returns expanded, but volatility was structurally dampened compared to prior eras. That pattern matters. As Bitcoin's market capitalization grows, it takes exponentially more capital to generate the same percentage move. That doesn't eliminate upside, it recalibrates expectations. Now combine that with post-halving supply dynamics. After each halving event, new issuance drops by 50%. The most recent halving reduced annual new supply to roughly 0, 8% to 1% of total circulating supply. That's structurally scarce compared to most traditional assets, but scarcity alone doesn't create price expansion. Demand acceleration does. So what would a true next cycle breakout actually look like? It would not begin with retail euphoria. It would begin quietly, with sustained ETF inflows, improving liquidity conditions, tightening exchange reserves, and price holding above key realized cost basis levels. It would look boring at first, sideways grind, higher lows forming, volatility compressing, sentiment divided. Then gradually, price reclaims prior resistance levels with strong volume confirmation. Not wick spikes, driven by leverage, but spot-driven expansion, supported by consistent demand. Leverage would increase after the breakout, not before it. That sequence is critical. If leverage expands before structural demand returns, rallies fade. If structural demand returns first and leverage builds on top of strength, momentum sustains. Now let's discuss realistic forward pathways over the next 12-24 months. Pathway 1, extended consolidation before expansion. Bitcoin ranges broadly, shaking out both bulls and bears. Macro liquidity slowly improves. Institutions accumulate during volatility. Breakout occurs later than most expect, potentially extending the cycle timeline beyond historical averages. Pathway 2, mid-cycle correction before final expansion. Bitcoin experiences a deeper retracement, 25% to 40%, due to macro stress or equity weakness. Sentiment turns bearish, long-term holders remain steady, liquidity shifts positively, strong rebound ignites final leg of expansion. Pathway 3, liquidity. Surprise to the upside. Rapid rate cuts or unexpected macro easing ignites aggressive capital rotation into risk assets. ETF inflows accelerate. Bitcoin breaks prior highs faster than consensus anticipates. Volatility spikes as late shorts are forced to cover. Which pathway is most probable? Right now, the highest probability scenario appears to be continued volatility within a macro stabilization environment before decisive expansion. Not instant parabolic mania, not structural collapse, transitional accumulation, but probability shifts quickly when liquidity shifts. Now let's talk about psychological traps, because this is where most investors lose. Trap 1. Expecting identical cycles. This cycle will not mirror 2017 or 2021 exactly. Market structure has changed. Institutional participation changes volatility dynamics. Diminishing returns change percentage expectations. Trap 2. Confusing corrections with cycle death. Bitcoin has historically corrected 30%, 50% multiple times within bull phases. Volatility is normal. Structural breakdown is different. Knowing the difference requires data, not emotion. Trap 3, entering only after media euphoria. By the time mainstream media declares a new Bitcoin supercycle, a large portion of the move has historically already occurred. Now zoom out one final time. Supply growth, permanently reduced. Institutional access, permanently expanded. Macro tightening, likely behind peak levels, though not fully reversed. Long-term holder conviction, still structurally strong. Those are foundational pillars. Does that mean straight line upside? No, it means the structural case remains intact, unless liquidity collapses aggressively and persistently. So here's the key metric stack we will monitor at Bullion Finance News going forward. Real yields, trend direction. US dollar strength or weakness. ETF weekly net flows. Long-term holder distribution behavior. Credit spread expansion or compression. Exchange reserve trends. When these align positively, the breakout probability increases dramatically. When they diverge, expect chop and shakeouts. The next major move in Bitcoin will not reward emotional reaction. It will reward disciplined observation of liquidity, positioning, and structural supply. And here's something most channels won't tell you. You don't need to predict the exact top or bottom to win this cycle. You need to recognize structural shifts early enough to position rationally. Bitcoin does not move randomly. It moves in response to liquidity and confidence. When liquidity improves and confidence returns, Bitcoin amplifies that shift. When liquidity tightens and fear spreads, Bitcoin exaggerates that contraction. Right now, we are between those extremes. That's not weakness, that's preparation. If you want data-driven, macro-backed Bitcoin breakdowns without hype, without blind buy or sell calls, but with real structural analysis that helps you think ahead of the market, subscribe to Bullion Finance News. Because the next expansion phase won't wait for emotional consensus. The cycle is not defined by headlines, it is defined by liquidity. And liquidity is shifting. Stay prepared.